Your house is worth whatever it's worth, right? Whoever sells it. Wrong. I'm Charlie. Welcome to Moving Home with Charlie, and thank you for coming.
Charlie Landing grew up in Sussex, is the founder of Best Agent and presenter of Moving Home with Charlie.
If you want to find one of these guys, look out for those compassionate professionals. All estate agents are not the same.
So Charlie, what would be your advice for people interested in buying new builds right now?
Don't overpay. Do buy, but don't overpay. That's why I say disregard the guff. Read into the numbers and look, and it's buried. The bad news is buried in the small print, okay?
Good evening, everyone. Welcome to the Property Press Awards.
They may or may not be telling the truth, but you should form your own view. Get out and view, get out and view, get out and view. You cannot be in a position to make offers and have no offers accepted if you're not viewing. So be out there viewing. Pay attention to the back of the class. If you've not been watching my videos, I did one just a couple of days ago. Disregard the guff, guys. Good evening, everybody. This is Moving Home with Charlie. I'm Charlie. Welcome back to all my existing followers. Special welcome to all the new, lots and lots of new followers and subscribers on YouTube, a lot of new followers on Twitter. I hope you will get some value out of this evening's live stream. I'm drinking lemony tap water again, which is a sobering sign. We are in extraordinary times in the mortgage market, certainly. And this evening, I've got my two mortgage broking partners, who are the guys who, when those of you who are kind enough to come through me to look for an independent whole of market broker, these are the guys that you'll be talking to. A couple of bits of housekeeping just before we get started. For anyone listening on audio podcast, if you want to watch the video of this, there's a link below in the show notes of the podcast, a link to watch the video. And for those of you watching on YouTube, if you haven't got time to watch this, there will be a link after the show put in here to where you can listen to an audio podcast. You guys can find me. YouTube is where I do most of my video work. Twitter is where I do most of my day-to-day updates. But I'm also on Instagram and LinkedIn and Facebook. Also 10 p.m. tonight, so 2 hours from now, I'm doing another live stream. So it's a double bill tonight with Alex Groundwater, also known as Housing Stig, or AI Stig, Actual Intelligence Stig. We've found some advanced information on the land registry figures being published tomorrow morning on house prices, and are expecting house prices to be announced, actually, that they went up in May. But we'll talk about that and the time lag effect on that. But without further ado, I want to bring in Graham and Lewis. And specifically this evening, what I'm hoping you guys are going to do is send in your questions about how what's happening in the mortgage marketplace is challenging your moves or affecting your moves or changing your moving decisions. And I'm going to be asking Graham and Lewis to share with you what they are experiencing at the moment and how it's affecting them and their clients. So just one more minute before I bring them in. We've got the following story just came out 2 hours ago on the Independent. Fears that mortgage rates could hit 7% as experts say rises are out of control. And on Bloomberg this morning, there was a story. Here we go. UK 5-year mortgage rates breach 6% for the first time this year. But enough babbling from me. Good evening, Lewis, and good evening, Graham. How are you both?
All right, Charlie.
You all right, Charlie? How are you now? You're good?
Bit frazzled, actually, honestly, and but nothing compared to what you guys must be going through.
Yeah, a little bit.
I'm got a bit of punk today. So.
Oh, I'm jealous. I'm jealous.
I've got
IPA.
I've got something that looks like it's from, I don't know, somewhere in Germany.
Yeah.
I'm double bubbling. I've got gin as well.
I've got Devon's finest tap water with some lemon juice squeezed into it. So.
That's all right. It's good beer.
Although, actually, I had a very good weekend. Went to the Guns N' Roses gig in London on Friday night, which was fantastic. Ooh. And then to a friend's 50th birthday party where I was fully dressed up in drag, actually, on Saturday night, and I was suitable hangover for a couple of days. So lemony water is just what I need.
Big weekend.
So guys, let me... Lewis, let's kick off with you. I know we've been messaging and you've been tweeting a little bit of despair about what's happening in terms of interest rates and what it means for the market. So I'd love to kick off by asking you, just what obviously higher interest rates mean higher payments for people, but what are the other effects of these frequent and significant rises in interest rates as far as you're concerned?
The biggest one is managing people's expectations, because, of course, we aren't party to when lenders will pull rates. We do get some prior notice compared to the general public. That might be an hour, it could be 24 hours, it could be 48 hours, it could be over the weekend. But we have no idea of how long it will be. But now, of course, because the time it takes to find a property, the actual buying cycle. So I just saw a comment coming there. Because of the time of the buying cycle it takes. So it may be the case that I see a first-time borrower, someone wants to move home, and I might see them today, but they might not find a property for 2 months or have an offer accepted for 2 months. But of course, if that was 2 months ago, we were talking about one set of figures. They've got their budget, they go away, they come back, and then we're completely looking at a completely different set of figures. Which, I mean, if they're on the edge of affordability, that can be the make or break. It could be actually, well, we've offered this price. What does that mean for us? Well, actually, I don't want to pay that mortgage payment, so we're going to remove the offer. So there's that, and I think because the speed at which things have changed in the mortgage market, specifically after the mini budget, it was very, very rapid. Again, we've had a period of rapid volatility in the past, certainly 6 to 8 weeks, and so it makes it difficult, as I say, manage expectations, but also you can feel sometimes with buyers the deflation, kind of thinking, oh, this was my chance, and now it's not. So that there is an element of that, to be honest.
So what you're saying is that first-time buyers coming out, they're trying to get a mortgage in principle, trying to get an idea of what they can actually afford to offer, and then by the time they do make their offer, they come back to you and the numbers have all changed. Is that right?
Yes, yeah. I mean, it could have done, especially, for example, if I'd spoken to someone 2 months ago, we were still in the mid-4s. Thereabouts, 4.5% ish. If they've got only a smaller deposit, and then we're talking to someone that's coming back today, tomorrow, Monday, we're kind of edging towards 6, and that can make a big difference when you're borrowing £200,000, £300,000, or in excess of that in some cases. And it can be the deal breaker. Especially because prices are still very, very high in comparison to wages, and therefore, if it's a case of it was £1,500 8 weeks ago, but now that's £1,800, well, that extra £300, that's your heating bills. That's the best part of 2 or 3 weeks food shopping.
So, are you experiencing buyers who set out with the intention of buying and they're changing their mind and not buying because of rates going up?
I've seen a couple of people, yes. I've seen a couple of people where they've had an offer accepted. I mean, not many, only a couple, but where they'd had an offer accepted, we ran through the figures, and they said, I'm just going to sit it out and wait for a while for things to calm down. I had that conversation, though, where it's a case of, well, waiting for things to calm down is not a 6-week endeavour. It could be a 6, 12, 18-month endeavour, So it's about the time frames over which this may peak and then hopefully calm down a little for everyone involved.
And just one last thing from you, Lewis, before I switch to Graham, which is, what is this? I mean, you mentioned the thing that Halifax has put one of their rates up, or as of 5 o'clock today. Is that right? A remortgage product with a 40% deposit?
Is that me? Sorry.
Yes.
Oh, yes. Sorry. Sorry. I thought you wanted to. Yes. So yes,
6.5% for with a 40% deposit or 60% loan to value.
Yeah. So the 2-year remortgage. This is remortgage products only, not purchase. But the remortgage products only. Yes, starting at 6.52% with a 40% equity or deposit. So that's a hell of an increase on what we've seen in the market over the past couple of weeks. I think the worry is, I suppose, that where they go, some may follow, and that's the big concern.
Right.
The big concern.
So, Graham, it's obviously the problem with this is, even for the people who've got the money to afford it, there's constant changing of rates is very discombobulating, to use a Blackadder word, I think it was, isn't it? It just keeps moving the goalposts for everyone concerned, and that, of course, it shakes deals that are in the chain, doesn't it? It can actually cause chain deals to fall apart, even though everyone in the chain wants to move. These things happen, and actually the chain gets broken. What are you seeing?
Yeah, I mean, echo what Lewis said. Really, we're seeing couple of clients, I'd say, where things maybe they've come back and rates have moved to such a degree whereby it becomes unaffordable.
Sorry about
It's all right. I got you clicked the link again by mistake, so I put you into
that. No, this battery's about to go. I'll jump back in. I'll be in 2 seconds.
Okay, no problem. Yeah, sorry, that was a very.
Was it my fault? Was it?
No, it's me. It's me.
So we've seen a few people where rates are getting to a point where they're having to sort of leave a transaction. Not massive amounts yet, buoyed probably by their deposit levels and the area of the country where we operate from. The other thing which you mentioned there, which you think is key, is you mentioned about chains sort of that are already in place falling apart, and especially where things are going on so long that people have got offers arranged and offered agreed at historic rates. And I had a phone call today with a client whereby there's something with the solicitor that needs sorting out, and they're coming down to the last 2 weeks of their offer, and they're saying, well, what happens if we lose this? And the fact is, it's going up by 2% or something. So that is where I think things could fall apart, where people have maybe locked in for longer terms historically in the last 6 months, but are now getting to a point where if they don't complete, it's going to cost them a hell of a lot more, and that puts deals in jeopardy. So it is not. It's not fun. There's no winners in any of this. I mean, I'm sure there's somewhere in the banking world, but from our side, working with retail clients, it's not. No one's rubbing their hands with glee. It's sticky, and you say the goalposts are getting moved every week, every 2 weeks, whatever it might be, and sometimes multiple times in a week with the same lender. So it will be interesting to see what happens going forward, but it's certainly not looking like anything's going to change in the immediate future, I think it's fair to say.
Yeah. Well, I've got a few questions here. In fact, one I sent you, which I thought was a good question. I sent it on WhatsApp to you beforehand. And the question was,
got it.
Are mortgage deals like this, in other words, that 6.5% Halifax remortgage, limited to a certain number of people? I mean, if they sell out, will Halifax release a new offer that's even more expensive? Is that how it works? They have a certain.
It's not limited to a number of people. It's limited to a tranche of funds. So they have a certain amount of funding at that price, and then once that tranche has been sold, they will go back and look at what it's cost them to, if they're borrowing on the money markets, what it's cost them to borrow that money, or whatever their commercial decisions are at that point in order to reprice the new money and sell it. So half right. Yeah, it's not limited to X number of people. It's limited to X number of pounds or millions of pounds as it would be. And once it's sold, which is, that's when it comes back. So what we found with why lenders were repricing so quickly and so frequently is because they didn't have the confidence to buy large levels of funds and sell them as they used to. It would last them 2-3 weeks, whatever it might be. They didn't want to get their fingers burnt. So when they were getting money off the money markets, as it were, then they were getting less, and therefore it was selling more quickly, and then they were repricing because there wasn't that certainty in the market. It was very difficult for them to price, and that's what we've seen over the last, certainly in the sort of 4 weeks. Things have slowed down slightly, but there is still upwards pressure on rates. There's no doubt about it.
Yeah. And the Bank of England keep on hinting that as well, don't they? The rates are going to stay high for quite a long time. And I think, sorry, I'd also just want to add on that our live audience on Twitter is starting to give the live audience on YouTube a run for its money. The actual, which we can't see on here, but it's almost getting 1 for 1. So because you can't join in the live chat from Twitter, if you are watching this on Twitter, just send me just at me on Twitter with your question, and I can ask it here as well. Okay, so if you're watching on Twitter and you've got a question, just tweet me the question about to the guys, and I'll put it to them. Okay. So here are a couple of questions. Okay, this is an impossible question to answer, and of course it's not even a question that is any of our area of expertise whatsoever. It's just pure guesswork. But I raised the question because I'd like to make the point and see if you guys agree that it is not anyone's responsibility other than a borrower themselves to decide what they think is going to happen in interest rates in the future. Would you agree?
Yeah, 100%. If I knew where interest rates were going, I wouldn't be doing this with you. I'd be minted.
Yeah, exactly.
I'd have a position against it. It'd be absolutely. It's not. This is the sort of, and I want to sort of, there's a bit of confusion out there as to how, if Lewis and I think we benefit. It's not for us to. We're not soothsayers. We don't look into the future and say this is what's going to happen with interest rates. Our job is simply to guide people that want to be active in that market. We're not in the business of cajoling people into doing things, recommending they buy a house, recommending they don't buy a house.
Yeah.
That's a very personal decision.
Yeah.
I know obviously a lot of things we're dealing with here is people moving home, but remember that 50% of what Lewis and I do is about people coming off and remortgaging and securing rates for the future for their personal sale. They're not moving house. Yeah. So we have no vested interest. I think Lewis agrees. I want to see a stable economy. I'm not. There is 230 billion pounds of lending or something going on this year in the UK. My business doesn't need much of it for me to make a living. Yeah. So you've got to remember that a decent advisor, and we are advisors, we've got scruples, we've got ethics. It's not about I've never tried to convince them to buy a house or told them not to. That's a very personal thing, and very conscious that if anyone is saying that, oh, you've got to do this or you should do that now before things change, well, they're not the right advisors, not the right people. So where interest rates going to start to fall, your guess is as good as mine, and it is a guess. And what we tend to say to clients is that you've got to make the decision when you are buying a house, or if you're remortgaging, whatever your rate decision is going to be, you can only make it on the data that is available to you at the time. All right. Yeah. So if you get 2, 3, 5, 7, 10 years in from wherever it is you make this decision, as long as you can look back and say, do you know what, if I was presented with that information again today, I would make the same decision, then that's the best you can do. Because hindsight, you're always going to know what you should have done. I should have bought multiple properties in 2003 when I just graduated, but I didn't. So it's things. So if we knew where they were going, we'd be vastly wealthy and be very wary of anyone that claims to know what's going on with interest rates, because it's a nonsense.
Well, having seen this question, I mean, I get the question. It's one of the most common questions. What's going to happen to interest rates? What's going to, and it's really important that it's what's quite clear is that not even the Bank of England know what's going to happen to interest rates or when, right? Because they certainly weren't predicting they'd be here this time last year. They were suggesting, oh, it's transitory, it'll be coming down. They were wrong. So nobody knows. People can make educated guesses on the medium term, but it's still just an educated guess at best. And I think for home movers and borrowers making these decisions, your decision is either, am I someone that values certainty, or am I someone that enjoys risk? If you're someone that values certainty, the longer you fix, the better. Simple as that.
And can you afford risk as well? I mean,
absolutely, exactly.
If you're 85, 90%, 95%, whatever, and incomes have been stretched because of whatever's happened in your circumstances, then there's no way you should be looking at anything that's going to be variable. No. You need to lock in, but then the clients that are more affluent, where money's less of an object, and they do exist, these clients, and they'll take a punt on it.
Yeah, and they're almost like they know they're rolling the dice. They've worked out their downside. They know what the downside is, and they're actually okay with it. Yeah. But if you're someone who wants a stable life, just to know where you are, know how much your bills are, then the longer you fix for, the more sense it makes. Maybe rates will go down, and you could have got a cheaper one, but does that matter? You're not going to be worse off, because you'll know where you stand. And I think that there are a lot of people who fix for 2 years who wish they'd fixed for 5. So
it brings certainty, but it brings that comfort.
There'll be people that fix for 5 that wish they'd fixed for 10. And there'll be people that fix for 10 that wish they'd fixed for 20 if those products are available. I mean, in terms of interest rates, we don't know when they will fall. We do know the mechanism to look out for to get them to fall, and that's inflation coming down, and the economy kind of leveling out. So if we start getting some positive inflation news, then you can say that with a reasonable amount of surety that in not too long after that, when that starts filtering through, and we've had a few couple of quarters of inflation falling at a reasonably healthy rate, and it starts to level out, then interest rates will begin to fall. When that will happen, though, is anyone's guess.
Yeah, I think one of the things that I've learned from Alex from Housing Stig is that actually any economy needs to have interest rates slightly higher than inflation as the sort of default setting, because otherwise there's no point in having savings. And if no one's saving and debt becomes a more attractive thing than savings because interest rates are lower than inflation, then you end up in the problem that we're in now.
Yeah.
Right. I've got a question here. I don't know if this is a good question or not. A helpful question. No, I don't think it is. I'll ignore that one. Let's take this one here from K Art. If you do salary sacrifice, do banks take your gross pay or pay after sacrifice to work out how much they will lend?
It entirely depends on the lender. So some will take out all deductions. So whether that's a pension, whether it's
You're very quiet, by the way. So I don't know if you're able to speak.
I can speak up a little bit. Is that any better?
Yeah.
Okay, cool. So some lenders will take salary deductions into account, as they will, for example, share safe schemes or cycle to work schemes, that type of stuff. And some lenders will add it straight back in, including pension contributions, because it depends on their underwriting policy. Some are much more cautious, and some are much more take the view of, well, you could cancel it if you wanted to. You could opt out of the pension scheme. You could stop your share save. You could stop. You could give back the holidays that you're buying extra. So it entirely depends lender to lender.
Right. Okay. So that's a lender specific decision. Okay. Next question. Yeah, it's a bit. I don't know, Graham, if you want to have a crack at this one. How are your clients funding transactions? Because it seems impossible to buy at these prices with current mortgage rates.
Okay, I mean, if we're talking about purchases, which we presumably are on this channel, then access to deposits is key. And this isn't a new thing. I mean, certainly in the first-time buyer space for the last, 8 years probably, is a lot of help from parents or rich aunties and whatever it might be. Okay, so parental help, bank of mum and dad, that kind of thing. That's predominantly. It is very difficult, and certainly not in mine. It is very difficult if you are, a working single person or working couple with sort of around the average wage to save a deposit to buy a house, and that is a fact. I think we all know that, and that is wrong in my opinion. Okay, but that is true. So how are people doing it? It's deposits, and it's always been deposits. If you can gear yourself low enough because you've got access to the funds to reduce your lending, and you're buying with someone else, then that's generally how it's done. On those kind of first-time buyers, obviously the people that have built up equity in their house anyway, well, they've got that cushion and they can do their onward purchase through the normal means because they've already built it up. But it is tricky, and it is down to generational, passing gifts on, and in some cases, although rarely now with the way rates have gone, there was things like equity release schemes being used. Not something that we do in house, but that was another sort of mechanism that could be used to help.
Okay. Thanks. Right. Next question, one for you, Lewis.
Sure, far away.
Have you had any clients and this is Kevin H on YouTube, have you had any clients that you were sure would be approved are being declined in this climate? Are banks still keen to lend? I've heard conflicting statements.
It's very much down to the personal circumstances of an individual. There's no hard and fast rule to that. There are people that will be declined where it looked like it would be fine. There are people that thought they would be declined and fly through. So it all depends upon the personal circumstances, and trying to compare, what you think is apples to apples, you almost certainly aren't, because everyone they're a different age, they've got a different income, they've got a different credit profile, they've got a different address history. All these things play into the factor of getting a mortgage approved. And so there's honestly no real merit in terms of comparing that against. So if you're worrying about it, the only surefire way to find out is to go and do a decision in principle or make an application. Because trying to second guess underwriters, trying to second guess lenders' credit scoring systems is for the birds, really.
Okay. I've got we've got a lot of new followers here, and a lot of questions that I think are quite regular questions, but they bear repeating. And actually, question I'd like to ask you both, which we discussed in our first ever mortgage live stream, but it's worth reminding people. Why should a borrower go to an independent broker, especially one they might have to pay a fee to, if they could just go to their bank, a high street bank? What again, for someone that's just brand new to this and goes, well, I don't understand what's the difference. If I can get a mortgage from a bank, why would I come to a broker? Just want to remind everyone what you do that the banks don't or can't do.
So I'll just take, I'll pick up on one, and it relates back to a question there about salary sacrifice, and then Graham can answer in a more with a longer answer. But for example, let's say that you are happy to save because you've got a great company, you've got a great share save scheme that's really beneficial. They've got a great pension scheme, and they'll match or double what you put in up to a certain level. And so you're saving all this money, and it's really, really beneficial for you. But you want to buy number 1A high street. That you think, I'm going to go online and speak to whoever my bank is, or I found this deal on one of the search comparison tools, etc. And they come back and go, you can't borrow that amount of money. But that's because they're taking all those deductions into account. Now, you wouldn't know that unless you've got the time to sit reading criteria and understanding how to find that and what it all means. Whereas we can take one look at the pay slip and go, okay, I know where I'm going with this because there's so many deductions going out. I'm going to go to these 3 lenders. So it's about understanding the market. It's a much more complex thing than people give it credit for. It's not just the same as getting a personal loan. There's many more moving parts. There's much more to take into effect when you're looking at mortgages. It's a huge legal transaction. So it's got to be right, and you won't know what you won't know because you've never done it before.
Yeah.
We do, because we do it day in, day out. I wouldn't get a mechanic to change my brake discs. I wouldn't change my brake discs. I'd get a mechanic to do it because I don't know what I'm doing. Yeah.
Go ahead, Graham. Do you want to add your own answer to that question?
No, I mean, Lewis has covered it. It's one of those things. I mean, the best way to explain it is we're on the side of the person buying a house in this instance.
Yeah.
We're there all the way through from day one. We've got no vested interest except to our clients, right?
Yeah.
So you go to. I always explain it to my clients as sort of it's twofold. It's 50% financial advice. It's 50% customer service, right?
Right.
You try and get an appointment with your bank. It'll be 2 weeks or a week, and you're going to speak to someone for an hour who's going to read a script, and then they're going to eventually tell you that one of their 5 products is, or whatever it might be, is what is right for you. Okay. It's in the same way I'd recommend someone gets independent financial advice and doesn't go and just buy whatever their bank was flogging. It's just, it's not for me to convince people to use brokers. The fact is the market is about 87% of transactions go through an intermediary, right? So it's what people like for those reasons. But I mean, we could spend hours going through, I think Lewis hit the nail on the head. It's one of those things, we don't know what you don't know. Things that look, it's kind of like, well, lots of people buy houses, therefore it must be quite straightforward to get a mortgage. Well, no, it's very complicated. I was amazed when I first started doing this job about how complicated it was, looking back all those years. And that was in the days of self-cert. So,
yeah.
It's gone far more beyond that. But knowing, I mean, I think this live answers the question itself. I mean, look at all the questions you've got coming in. This is why.
It's the point. I mean, one of the things that amazes me is how many buyers go out there and start looking at properties before they've spoken to a mortgage broker and don't know actually how much they grow. And that's just because they don't know where to start. So they start by going looking at properties. And that works for some agents because agents have got in-house brokers and they like to get their business. But you're better off to have an idea in advance before you start looking, and you go out looking with some sort of mortgage in principle. The other thing I think is that, I mean, what I see is that every lender's products are all slightly different. They all have slightly different criteria. They all have slightly different parameters and preferences and types of borrowers they prefer and all this kind of stuff. And what you guys do, and where I think you add the real value, is that you talk to your clients, you find out what time of life they're at, their age, whether they've got family or not, whether they're likely to be moving, whether they're going to planning to release equity from their house later, or all of these things. And you're then in a position to go, well, actually, with that in mind and knowing what your future plans are, the kind of product you should be looking at is this. And that's the sort of thing that a bank won't necessarily do.
Spot
on. So it's not just about how much can I borrow. It's, well, which lender should I be talking to? Which one's going to be more like
the structure of the debt? It's the structure of it, and it's where we have conversations where people have approached banks and they say, and you say, well, have you looked at it this way? And they say, well, I've never even thought about that. It's just.
I mean, the other. Sorry to interrupt you, Graham. Just while it's fresh in my mind, the other thing that I thought was amazing was the fact that some lenders when you're moving house will allow you to port your mortgage, even if you sell complete once and don't have the new one bought yet. So you can still hold on to that product. Some will only give you 3 months, some will give you 6 months. But again, if someone's planning, well, we know we're going to need to move in 3 or 4 years' time, and then okay, well, then you want to go to a lender that maybe has that ability to port your mortgage. And if you don't, and then you get caught out in a market like this, you can be in real troubles. It's just, yeah, they all have different, and of course, all of those things are changing, never more so than right now. So I think, yeah, and again, hit the nail on the head, customer service. Like, you got clients ringing up going, what should I do? What's the best thing for me to do? And guys, the reason I've partnered with Lewis and Graham, people who I'd never met before I started this channel, actually, I only encountered them because of this channel, was because how different their approach to their customers is from many mortgage brokers that you hear about and come into contact with. They, in my view, and actually is being borne out in the experience of all the customer feedback I'm getting so far, they care about you. They care about their customers as people more than average, right? I'm not going to say that there aren't other people that do it. There are other brokers out there that do the same, but you guys, more than average, definitely look out for your customers' personal interests. It's not just about flogging them everything you can on your list of products.
No,
We'd be around long, wouldn't we?
Point out in terms of why I use a mortgage broker, probably I'd say a good. So my business is split down in, broadly speaking, thirds. A third of people have got a mortgage and want to move home. A third are remortgaging, and a third are first-time buyers. But of that third that are first-time buyers, in fact, no, it's probably the 2/3 that are buying and not remortgaging. Of that, I'd say at least a quarter, if not a third of that 2/3, are people that have thought, I'll go online, I'll do myself a decision in principle, and then I'll crack on. And then they come unstuck at the first hurdle. That is far more common than people realise, for the simple reason that you won't know what you're looking for. And that doesn't mean that's not meant to sound patronising in any way, shape, or form. But for example, if you've got commitments going, so let's case in point, if you've got a standing order that you pay to your granddad because he lent you some money to buy a car. So you've not got a credit commitment, but you're paying him 250 quid because he gave you 10 grand and said, go get a car, give me 250 quid a month back. You pop all your details into whichever online lender. They then say, right, send us 3 bank statements, 3 payslips when you've had an offer accepted. Straight away they go, what's this standing order? You tell them, no, we're not taking that because that's a commitment. Even though it's not a debt, it's a commitment. Whereas we could spot that and go, that's going to be an issue before you've even started. So actually your budget is not quite what you thought it was.
Right.
And that happens so often, it's unbelievable.
Yeah. Right, let's take some more questions, shall we? Here we go. So here's one. By the way, guys, if anyone who needs to talk to a mortgage broker, whether you're remortgaging, whether you're moving or first-time mortgage, mhwc.co.uk/mortgage. It's in the link is below in the description, and your details will go to these guys, and one of them will be in touch with you. Now, so just a comment on this, not really a question, but someone called No One on YouTube says, I feel for everyone having to move. I was served a Section 21 because my landlord couldn't afford the rates anymore. So do you guys have many landlord clients, or are you mostly sort of homeowners?
Yeah, we do. Yeah. I mean, few of the buy-to-let market is, I don't know what a polite way of saying it. It's not good.
Yeah.
Not good. It was the first thing to get really strung out when the interest rate rises, because the direct correlation between the interest rate charge, the rental coverage, and the amount you can borrow. So we've seen the buy-to-let market get squeezed progressively over the last 6 or 7 years with regulatory changes, the tax changes, things like that. So all the time, the amount of rent required to borrow a given sum of money was increasing. I think you had to have more rent to get that sum of money. The rate increases have just exacerbated that. So, they're stress testing up at, 145% of 6.8% or something, so wow. You start working those numbers backwards. People that have owned properties, landlords that might have owned properties since 15 years or so, longer than that. It's never really been quite like it is at the moment. So because when rates were higher pre financial crash, the rental stresses were still always 125% of pay rate on an interest only basis, even at 5.5% and 125 it fit. Because if a landlord's a high rate taxpayer, they're going to get stress tested on 140, a rental coverage of 145%. Try not to get technical, but the net result is you need more money, rental income, to get per pound of borrowing than you used to. So this is leading to increased pressure on rents. A lot of landlords are saying, well, I haven't done a rent review for 5, 6, 7 years. They're really good tenants. I don't want to, but I'm going to have to. Right. So we've got this double-edged sword. On the one hand, you've got the affordability being impacted for residential borrowers, and also the need to have larger deposits. But then the rental market's getting squeezed as well. So the people that are renting are having to use more money for rent, which in turn means they can't necessarily save the money for deposit. So I'm a firm believer that I think, rental reform is pretty important in the grand scheme of the housing debate that everybody's having. But it's going to take
I have a really simplistic view on this, which is that, if you're going to provide somebody with a home in return for money, that home should be secure. They shouldn't be required to move out because it's not convenient. I mean, it's unfortunate. I can see why it's happening for landlords, but landlords in that situation, I mean, it's impossible to deny the fact that they have overstretched themselves. They're not, if they can't afford the mortgage now, and so it's really, really unfair. It's a bad situation for everyone. It's bad for the landlord and it's bad for the tenant. It's just a bad situation all around.
The buy-to-let lenders stipulate that they don't want ASTs in excess of 12 months for the most part.
What?
Don't they, Lewis? 2 years maybe max,
Yeah.
They won't lend if you've got. Lenders won't lend you on 12 months. I think you might get 2 years, 12 months, but if it's beyond that, they won't, because they want the ability to be able to take possession of the account. So they will ask you, what is the length of this AST? 6 or 12 months is okay. Beyond 12 months, then sometimes will do it. Go over 2 years, and a lot of people won't touch it.
I didn't know that.
No, well, a lot of people won't. But because their argument is, if we need to take possession of the property, we need a break in that ability to be able to invoke those things. Now, again, I'm with you on that. Shock face review. That's not right. If we can give a bit more security that those that are renting and level the playing field a little bit on that side, well, that will cool everything on the residential, the purchase side, to my mind, because people have security. And we are talking, we get, we're all guilty of it here. We all get caught up in numbers and the economy and all this, all right? But we're talking about homes for the most part, not the landlords. We're talking about people where they live. Yeah. And that's important, like you just said. So the rental sector needs to have a bit of a light shone on it from a regulatory perspective to say, how can we give people more security, and how can that trade off with lenders and to really look at it. Someone far cleverer than I am.
It's very, very difficult. I think you can actually, this is going off on a tangent, but you could actually trace people's lack of security of tenure of their home back to the massive skills gap we now have in the population, where you've got all of these high-paying job vacancies, and we haven't got any people with the skills to fit. Because if you keep being kicked out of a house for whatever reason, but when you're not behind on your rent, you haven't done anything wrong, you're being bumped around left and right, you can't get on with your life. When you've got moving house is massively unsettling, especially when it's not something that you chose to do. It's hard enough when you do choose to do it.
You can't make decisions on, it's harder to make decisions on employment, on family, on everything, because you've got this kind of, well, am I here for 6 months? Am I going to have to, it's not good.
Right. So it's a comment from Kevin H. My lending power dropped 30k pretty much overnight. I was looking at 260 in May. My mortgage advisor now says 220 to 230. House prices haven't dropped that much to offset the drop. It's brutal. Yeah. Anthony I says, has there been a significant drop in first-time buyers in touch? Has there been an increase in flats being of interest also? My gut feel would be even more of the first-time buyers are going that route rather than houses. Lewis, you got a view on that?
To be honest, so there are fewer first-time buyer inquiries, but the ones that are inquiring are much more serious and they're ready to go. So in terms of actual transaction volumes, for myself, certainly, they've stayed broadly the same, but I've just spoke to fewer people, but still done the same number of applications, because if it's right, it's right. So if you've been saving up for however long, if you've found the right property, got it to the right price, all that kind of good stuff, then why wouldn't you do it? Because if the mortgage is going to be equivalent to or cheaper than your rent, you've got an asset that will, over the long term, likely track upwards.
Right.
So yes, the phone is ringing less, but I'm still doing the same amount of business.
That's interesting. Okay. Here's a good question. Emma Anderson, it's a general question, but are lenders tightening affordability criteria?
So on that one, they're not tightening criteria as such. However, if you're going for less than a 5-year deal, then generally the stress rate is harsher. And as the interest rates have risen, not only is of course the headroom that you need to be able to afford to pay that mortgage payment risen, but also the standard variable rates have risen. And it's the standard variable rate plus the stress test that lenders factor in when assessing, certainly at 5 years or lower, into, well, below 5 years as a fixed rate product. And therefore, yes, in some circumstances, people's affordability has lessened, but if that's typically if you're going for a shorter term deal, because the stress tests have become harsher due to increased SVRs off the back of bank rate rises.
Okay. One for you here, Graham. Someone called Hatecraft Paladin on YouTube says, I'm in the process of transferring a mortgage from one property to another. Will the interest rate go up, or is it locked to original agreed?
So, good name, isn't it? Hatecraft Paladin. That's takes me back to my World of Warcraft days when I was a hairy student. If it's a porting mortgage question, which I'm going to assume it is, if we move one to the other, then if you've made an application, the porting element is your existing mortgage, so your existing product. So the amount you borrowed on that rate and what you owe, that very nature of porting is you're going to move that across to the new property. So that rate is locked in. If you're taking any further borrowing, then once you've made the full application for the whole transaction for the port, then the top up bit, that will be locked in as well. So rates generally are locked in when you make a formal application to the lender, not a DIPS. There are a few exceptions, a couple of exceptions where you can secure an interest rate on decision in principle, but those are the exception, not the norm. So yes, if you're in the process of it and you've applied and you're going through all the paperwork with the bank, then yes, once that application goes in, you would lock the rate in. And then when your offer is valid, when your offer is released, most lenders, that's then going to be valid for up to 6 months or thereabouts. So yeah, you should be all right.
Okay. Do you want to take this one as well, Graham? Question, where are the bank of mum and dad coming from? Are they remortgaging their own property? Or have they just got cash in the bank?
Some are cash in the bank. Some will refinance their property. Depends how old mum and dad are. Some might have inherited from grandparents. It's gone to them and they just did a variation on the will and passed it down. So it comes from all sorts of places. But yeah, the people that have accrued assets and wealth throughout their life, people that are now in their between 60s and 80s, I'd say. But some will remortgage it because there are things. There's certain mortgage products called joint borrower sole proprietor, okay, whereby you have multiple borrowers to help with the income, but only one or two people on the deeds of the house. All right. Now, those are quite good because you could use somebody else's income, often a parent. However, because that parent is older, you then tend to squeeze the term down because you're limited by the maximum age of the applicant. So in that way, you can almost split that transaction down. So what you might do is say, well, actually, instead of doing this JBSP thing with a couple of lenders, it's a bit complicated. Mum and dad refinance their house for the deposit they need of 50,000. And if they've got, they're 56, 57 years old, whatever they might be, they've got 10 or 15 years to pay that back. And then the children get the mortgage on their income and they can stretch their term up to the 20, 25, whatever they need to do. So you kind of split the transaction out. So yeah, it comes from all sorts of places. There are people out there with money and there are people out there which have the assets that they can gear up. Buy-to-lets, again, they might have a buy-to-let that's got a lot of equity in it. They can pull stuff out of there. It really much varies from person to person.
There's a slightly related question here next. Tired Gunnosaurus says, I'm 53. I have 17 years left on my NatWest mortgage. My 5-year fixed ends in November 25. Can I extend the 17 years? And if I can, will my fixed rate still keep November 25?
Extend beyond 7. You mean with the mortgage? So
I think he's asking if he can extend his fixed rate.
You can't extend the fixed rate now. It has a predefined end date, which will have been in your mortgage offer. It'll end on a specific date, and where you'll revert at that point to the standard variable rate of that lender, whatever that might be at the time. You may be able to extend the term of your mortgage. I don't know if this is related to, for example, the mortgage charter that Jeremy Hunt announced last week, as in where you can have a temporary extension or switch to interest only, for example. But no, you can't extend the fixed rate now.
Okay. Yeah, just scrolling through some of the comments here. Yeah, next question is, Yeah, probably quite a common question for you guys. Samantha on YouTube says, should you overpay your mortgage in the first 3 years or keep the money in a high interest account?
That depends upon a number of things. That there are too many variables there to consider. The first 3 years is not necessarily, I don't know where the 3-year thing has come from, but it depends on what your interest rate is, what your disposable income is, what your mortgage rate is, what the savings account rate would be. There are too many variables to answer that, unfortunately.
And what your aspirations are, what you're comfortable with.
Yeah.
I mean, you can always prove with maths what mathematically might be the best, but what do you feel comfortable with?
Yeah.
It's all very well to do. I mean, it's very difficult once you paid the money off your mortgage. It is more difficult to get it back. So, you're always cautious saying, make sure you've got enough emergency rainy day fund. And after that, do you invest and try and get a bigger return? Do you put it in a savings account, all that kind of stuff? Mathematically, yeah, it might be a way to go, but it's not one size fits all. People are very different. People are different, man. Like, do you mean everyone's different? People approach life differently. And that's a sort of personal question. I know some people that would would just keep them up at night if they paid it all into their mortgage and didn't have as much behind them as they wanted. Some people just like to have that nest egg and keep it there, and that's fine. That's absolutely fine and valid. So I think it's difficult to sort of say this is the right thing to do. You have to weigh it up and do the maths, but ultimately go with your gut on some things. It's not, as Lewis said, I'm always going to use very difficult to get the money back out if you need it for something. So make sure you've always got enough to back yourself in case something goes horribly wrong. That's the key thing, I think.
Okay. I'm listening with one ear and also looking at questions. The next one. This is you must get this question. Lomax Digital asks, do lenders accept Bitcoin as a deposit?
A very, very select few do, but none of the mainstream lenders that I'm aware of anyway, Graham. The simple reason that the whole point of Bitcoin, well, one of the points of Bitcoin is that it's anonymous. That's one of the attractions of it. And of course, when it comes to deposits and how much of a deposit level you're putting down, they have to, for anti-money laundering checks, check where that money's come from, that it's come from a legitimate source, and then they can trace that source back. But of course, the point of Bitcoin is that it is anonymous, and that makes it almost impossible. Unless you can start digging into all the transaction histories of what you've done, where it's been traded, where it was sat, all the ledgers and all that kind of stuff. So there are a handful, but we're talking maybe 5 or 6.
Yeah. And interesting enough, Charlie, your legal partner has the ability to look at that and works with an accountant specializing in tracing of digital stuff to provide comfort for lenders. So
that's cool. All right.
So yeah, it can be done. Lewis is right, but it's there's an uneasiness about it. I think it's not well. I mean, obviously things that Lewis has said with it being difficult to find source of funds and money laundering, everything else. But I think it's one of those things where lenders are like, do you know what? It's a bit difficult. Easy just to close the door on it, but there are still some options, but expected to go through a fine-tooth comb.
And not to mention that as well, when it comes to, for example, anything. So for Bitcoin, I've had people in the past say, "Oh, I've sold my cryptocurrency, crypto assets, whatever they may be, and it's now just cash in the bank." Well, that's great, but the solicitor is still going to want to trail back through that and go through an audit trail to see where the original source of funds came from. So even though you may have sold the crypto assets and transferred that back into your bank account, they're still going to want to see where's that transaction come from? Where's this 15 grand just appeared from? Oh, it's from Coinbase or whatever place you might have had that stored. They're still going to then want to dig into that. So it doesn't just stop because you've got some money in the bank. They're going to keep going back until they're happy that they've verified the ultimate source of the wealth.
Right. Okay. Thank you. That was that was cool. This is a very general question, but Jennifer Jacobs asks, based on current interest rates, what percentage of deposit do you think will need to be saved for a 350k property? I mean, that's
minimum 5%. I mean, that's kind of
it's always minimum. Yeah. So there's still 95% lenders in this market.
Yeah.
Wow.
And weirdly, we haven't seen the rates. I mean, correct me if I'm wrong, Lewis, but they haven't gone up by the same margins as the lower loan to values, have they? I mean, they have increased, but not by the 1.5% we've seen down at 60% loan to value. They've stayed a little bit. I mean, they have gone up, don't get me wrong, but they have stayed a little bit more solid as to where they were. So they're not, they're not up at 8.5% or something, but they are. Yeah, they're still there.
I think 95% lenders are as brave as the buyers right now.
Give Skip to the call.
Here's a question. Okay, so Samantha asks, are independent financial advisors indemnified for giving dire, life-changing advice?
So we do have public indemnity insurance. Yeah, we do have insurance in place. But we're not independent financial advisors. We're mortgage brokers or mortgage advisors. So we're not qualified, Graham may be qualified, but we're not authorised to give financial advice, i.e. stock, shares, pensions,
Right.
etc.
Yeah.
But yes, we do have to have public indemnity insurance as part and parcel of trading and being regulated by the Financial Conduct Authority.
Right.
But that said, often people can sometimes misunderstand what we do. We talk to people, we ascertain what their preferences are, we then select the best product based on their preferences and then advise on the product. We don't tell them to have that product, we say these are the details of this product. There's a subtle difference there, but it's an important one because ultimately no one is putting a gun to anyone's head to say get a mortgage, buy a house. No one's doing that.
No.
I don't strong arm people into my office. They come to me, they say, I want to buy this house. How can I do it? What's the best way? Okay, well, let's figure out what your preferences are, what your wants, what your demands, what your needs are.
Yeah. Taking
Taking all that into consideration and basing it upon all the questions I've asked you, this is probably going to be your best course of action. And then, of course, they can say, yes, I agree, or no, I don't. And if they say, no, I don't, okay, so what is it? And then we'll kind of go through that process until we've nailed down what the right course of action is, and then advise on the product, not on which type of product.
So I've got a very long time follower, and he's a very, very strongly opinionated guy. And I'm going to bring his comment up now. It's quite a harsh comment, but I think it'd be good for you to address it. He says these mortgage lenders, well, you're not lenders for a start, you're brokers, right? Are not equipped economically to advise on the biggest debt purchase of most people's lives. Now, my first reaction to that is, Paddy, they're not advising on the debt purchase. That's not what you're doing. You're advising on which product to use if you want to buy a house. So someone comes to you and says, I'm going to buy this house. I want to buy this house. And your job as mortgage brokers is to go, these are the products on offer that might suit you.
And so this is the product that we think. Yeah.
You're not actually advising them on long-term financial decision-making, are you?
No, we're advising them on the structure of the debt. And I say, picking up what Lewis said before, is our job is to have conversations with clients to ask questions they maybe haven't thought of for them to come to their conclusion.
Right.
So it's very much it's a dialogue between advisor and client. It's, have you thought about this? What would you think about if this happened in future? And it's just knowing what questions to ask. But ultimately, we're dealing with grown-ups. People make their decisions based on whatever. It makes no difference from our point of view whether you're fixing for 7 years or 10 years or 2 years or doing a tracker for 5 or taking an offset. They're all different things for different people. All right. And that's the key thing. So, as Lewis said before, we've got, professional indemnity insurance. We are qualified. We are having to do regular CPD. We have to do training. Most of us have, got all sorts of qualifications. But if that's your view, then no one's making you come and speak to us. So it's all cool.
And also, I suppose to a certain extent, if Paddy doesn't know better, then go and do the CMAP and set up a mortgage brokerage.
Yeah. I just think it's important. I think I know where he's coming from, but I think it's a misplaced observation. I think he's talking about what are the best long-term financial decisions, but that's not your job. That's not what you're advising people on.
No, because for a start, so 10 years ago, let's go in 2005. Almost no one predicted the financial crisis. No one predicted COVID. No one predicted the war in Ukraine. No one predicted the inflationary crisis at the start of COVID. Right at the start of COVID. It was obvious what was going to happen when we started that. But all these things. So this idea that we can look into the future is just nonsense. We can't. We can deal with the here and we can deal with the here and the now, and that's all.
But is it true? There are less scrupulous mortgage brokers out there who will exploit a naive applicant who asks a question, what's going to happen with interest rates? What should I do? And they'll go, this is what's going to happen. This is what you should do. And they shouldn't be doing that. And I think that's where some of the reputation that some mortgage brokers have comes from is people that are frankly not qualified. To be, they should be saying, I don't know, that's your call. Like, we don't know what's happening.
Yeah, I mean, they're probably qualified,
Yeah.
but they're not ethical. And
Yeah.
there's good and bad in any profession. You know,
Yeah.
there's bent solicitors, there's bent policemen, there's you know, you name it. There's somebody willing to do something bad. So and actually, really, it just relates to something I saw in the chat comments there, and you may have been getting to it. But somebody just said, is it standard practice for brokers to keep the mortgage provider secret to the buyer until they're about to sign? No. Absolutely not. We show. I've got a policeman just outside. No, he's all right. We show. We show our clients absolutely everything, and people say to us, "Well, then I could just go and do it myself." Yeah, if you want to. We can't. You know, we're not your conscience. We're not your moral guide. But the point is that we want to work with people that want to work with us, right? And once they see what we've done and the value we provide and all that kind of stuff, people don't go elsewhere. But yeah, if you are dealing with someone saying, "Well, I found someone, but until you pay me, or you know, I'm not gonna tell you," run a mile. Because that's just sharp practice and nonsense.
We've got a super chat question here. Someone who wants to make sure the question gets answered. I've got a mortgage offer, but seller's chain probate is taking longer. Can I switch property without losing my current rate on the offer, as rates have increased with the same lender?
That is dependent upon the lender.
Right.
That is very dependent upon the lender. So some lenders, they will say you can make another application or we can switch property, but you have to choose a product from the new range. Some will say you can switch property, but often mortgage offers have expiry dates or product end dates. And if that product end date expires, then you would have to choose a new product from the current range. So it entirely depends upon the lender.
Sometimes you get really lucky and they say, yes, you keep the rate and the offer's valid for another 6 months.
Yeah.
So, you know, it could go from the worst end to the best end. I would say, Lewis, I don't know, disagree with me. I would say that more often than not, you can, though. Yeah, it would be unusual.
Usually you can. However, I suspect that with the amount of volatility, they may be less inclined to do so, or some lenders may be less inclined to do so.
Okay, right. Just one more question, and it's time to wrap up. And guys, is there anything else you wanted to say or add during this video, or are you just happy to take these last questions?
No.
Urban Achiever asks, what's the best way to release equity in old age? Lifetime mortgage or simply sell and rent?
Well, I'm qualified to advise on equity release, although I don't. That's a big question. It depends on a number of things. It depends upon what your income needs are. It depends upon, do you need to leave, or would you want to leave a legacy for your children or grandchildren if there are any? It depends if you're going to need to potentially have care in the future. There are a whole host of things. It depends if you sell up and your assets are above a certain level, would that potentially put you in the realms of inheritance tax issues, etc. And so there are a whole host of problems there. So the best answer is to speak to a regulated equity release advisor, because contrary to common opinion, and I say this as someone that's qualified to give equity release advice, we have to demonstrate on a file, we have to demonstrate that we've explored every single avenue. So with a mortgage, someone comes to me and says, I want to get a mortgage. Okay, well, let's get you a mortgage. If someone comes and says, I'd like to get a lifetime mortgage and have equity release, I have to be able to demonstrate that I've explored every possible opportunity to not do it. And only once I can categorically say there are no other options, only then can you actually transact that piece of business, because of the risks that are associated with it.
Thank you. Right, very quickly, Graham, can someone remortgage if they have negative equity?
So, I mean, Lewis and I had a chat about this word the other day, because remortgage is what it means to me, what it means to him. So I class a remortgage as any time you're changing your deal, even if you're staying with the same lender. In my parlance, it's always been a remortgage, right?
Okay.
Technically, nowadays, we refer to those as product transfer. So that's where you're not going to a new lender, you've come to the end of your existing rate, and you're going to take a new product with that provider. If you're in negative equity, there are lenders that will have existing products available for you, even if up to about 120% loan to value. All right. However, you're not going to be able to go to a new provider if you're in a negative equity situation. But yeah, if we're talking about, can I get a new rate? I think it's probably a better way to appease Lewis so he doesn't come and shout at me tomorrow. It's going to be, yeah, generally with some lenders, they look to help. It's not in their interest. It's not in their interest to be doing it. So they have made product ranges available for the most part. Not all lenders, as we always caveat. I think everyone will get bored of us saying it's different for every case. But yes, there are some products available up to 120% loan to value.
Right, I've got 45 seconds to end this before I hit the 1 hour mark. And the last question we'll answer is, where's the Stig tonight? He's on at 10 o'clock, live stream. He and I, we are preempting, we're scooping the land registry's house price figures tomorrow because they've gone up. We're going to be explaining why the May figures went tomorrow are likely to go up. Guys, thank you both very, very much. Really appreciate that.
All right. Thank you for having me.
This is the regular one. Remember,
Good to
guys,
see you.
if you want to talk to them, mhwc.co.uk/mortgage is bottom of the screen now. Otherwise, thank you, all of you, for coming. Great turnout. Thank you, Lewis. Thank you, Graham. See you on the next one, guys. Have a good night. See you at 10 o'clock.
Thanks, guys. Take care. Bye-bye.
Bye.